Welcome to the Killik & Co podcast for the 28th of July. Just if we turn back to last week, equity markets just shied away from those record highs that we printed in the previous week. Some disappointing data on US housing starts did lead to a decline in yields in the bond market and a strengthening in the dollar. With geopolitical tensions still very much to the fore, it has been a return to safety somewhat and a little bit of risk taken off this market. But as we start the coming week, whilst we still continue to have many companies reporting Q2 numbers, it's the macro data, particularly out of the US, that's going to be particularly intriguing for markets. Most importantly, of course, is where we are with regards to the economy in the US. You'll recall that in the first quarter, the US economy had a torrid time. It was down 2.9%, and this was seen as a result of the very poor weather that was seen in the northeast of the economy and some spending slowdown in healthcare. The hope and expectation is that the US economy has seen a rapid bounce back in Q2, and indeed it is the consensus forecast that we're looking at a just shy of plus 3% number. There have been some concerns over the weekend expressed that if you put together some of the component parts that we've seen during April and May, including retail spending, for example, and consumer confidence, that we may struggle to meet those sort of quite high expectations. So that is going to be a fairly critical piece of data. It also coincides with the FOMC, who on Wednesday are going to be discussing interest rates, and indeed we have other data points this week, including consumer confidence and the jobs data on Friday. So a lot to work through, and a lot I think will establish in terms of our knowledge about the markets. In Europe also, some quite important data relating to inflation and PMIs. We know that in Europe it has been for some time now concerns about the low levels of inflation and the actions that will be taken by the ECB. So the net result of this is that if we see continued declines in those numbers, then the markets may well be looking for further activity. It has been a feature of the market over the last few weeks that the euro has been in decline. We'll take a look at a chart. On the corporate results side, again, a lot for us to work our way through. We have results from BP and from Shell. The really quite high levels of the oil price, which has been somewhat aided by the geopolitical tensions, has meant the sector has performed quite well during the course of 2014 so far. So we'll be taking a look at numbers there. We also have numbers from Merck. We recently published a buy note on Merck, and it's an interesting sector at the moment, particularly when you bring into account what is happening on the M&A side with AstraZeneca and Shire, and the disappointing results from Glaxo that we saw last week, which caused a 9% correction downwards in that particular price. We also have results out from the Lloyds Banking Group this week. So again, if you look back to last week, Royal Bank of Scotland shares were up 14% when they brought forward their results by a week and beat expectations by some considerable mile. That was as a result of keeping control of expenses, which were down 8% year on year. So let's run through some of the charts for last week. Starting with GlaxoSmithKline, it really was a very poor week for the business. There was probably guidance towards a 10% miss to earnings per share. Some of it's currency driven, but much of it, I think, is coming down to the strategy of GlaxoSmithKline. They have sold out of areas such as oncology, which went off to Novartis. And over the weekend, the Financial Times, interviewing the CEO, alluded to further breakups within the GlaxoSmithKline group. That hasn't actually helped the share price this morning. The shares are running, as we film this, broadly unchanged at the moment. So they're really trying to throw some good news into what looks like a deteriorating position for GlaxoSmithKline at the moment. With the shares off, it is the major underperformer within the sector. The US dollar is a feature. I mentioned about the sort of move to a risk-off basis. That normally aids the dollar, and we can see there this is a basket of currencies versus the dollar, and you can see that it is strengthening to a level that's been last seen back here in February of the year. So you can really start to tell that there is a little bit of a change heading into areas of geopolitical tension, but also some concerns about the pace of the recovery in the economy at the moment. So that is going to be a telling index. It probably comes at a reasonable time for UK businesses. The press this weekend have been really talking much about the strength of sterling recently and how that is impacting UK businesses that both export to overseas or indeed translate overseas profits back to the UK. So some relief there for the engineering and industrial sector potentially. I really want to just continue to put in the charts that whilst we talk enthusiastically about interest rates rising, about economies improving, that the bond market continues not to really relay that particular story. Yields continuing to decline. This is the 10-year index, back down below 2.5%, running into this all-important week. And the 30-year, and also quite telling here, back down to 3.25%. It's not an all-time low. The 2.7% it printed last year is the low, but you can see there that really the enthusiasm for the economic recovery and interest rate cycle has very much sort of petered out during the course of 2014. This is the euro. It did print an 8-month low against the US dollar. It could be that ECB policy actions are at work here. They really do need a cheaper euro to improve the export position of the European economies, particularly the periphery economies, and so that will be providing some welcome relief. It was one of the targets of attack for the recent changes to ECB policy. Commodities, well, not much to say on commodities, only other than to say that the mining stocks have been really good performance over the last 3 to 4 weeks. Stocks like Glencore have added around 20% to their market capitalisation in the course of the last month. Rio Tinto's been strong, and record iron ore production out of Billiton. So for me, again, it is one sector that we've been talking recently about a relative bet versus the market, and it's beginning to pay off at the moment. This is Merck. Just to say that the results, as I pointed earlier, are due tomorrow, so we look forward to that with some interest. The share price posting some good relative performance against some of its UK peers. Really a 5-year analysis of Merck would suggest that they're outperforming by about 70% compared to GlaxoSmithKline. The question is, can Glaxo overturn some of that underperformance with its sort of strategy, which at the moment is in dire need of a bit of an overhaul. Travis Perkins out of the building sector, their results are due this week. The house building sector has rebounded, and others within the construction markets are doing quite well. I feel that Travis Perkins has been left behind a little bit in share price. They could have a bounce. They're starting Monday morning this morning with a bit of a firmer tone, and this is ahead of numbers last week. The real push and pull here is that last week we had disappointing numbers from Kingfisher, but that was more relating to its French and Polish businesses. But numbers from Howden, which is involved in the UK house building market, supplying kitchens, were very strong indeed. And Travis Perkins will be the third component to report this week in that sector. That's all from me. If you do want any more live sort of updates to the market, you can follow me on Twitter, where we do keep followers abreast of market developments as they happen.